Hi, this is Ann from Finance on the Offense, and today I'm going to go over index funds, mutual funds, and ETFs and how they all work. All right, let's get started. Mutual funds. So first I'm going to explain about mutual funds, and if you're already very clear on what those are and how they work, I'll put a link in the description below so you can jump to the index funds or the ETFs. Alright, so mutual funds are made up of lots of different assets like stocks or bonds, and this bunch of assets is called a portfolio. One mutual fund can hold hundreds of different stocks or different bonds or some other asset. This means when you buy a mutual fund, you're buying a lot of different assets, so you're already diversified, and that's really nice. If you tried to buy one share of all the different companies that you own inside that mutual fund, it would just be way too expensive. You couldn't afford it. So mutual funds work by pooling your money together with a lot of other investors' money, and that way you can all get a chance to invest in things that you normally wouldn't be able to. These funds are mutually funded, and that's how they got their name, mutual funds. With most mutual funds, someone actually manages the fund. They buy and sell assets inside it. So maybe they'll think, oh, well, Google's supposed to do badly next quarter, so I'm going to get rid of that one and I'll buy Walmart because Walmart is supposed to be good because of this thing I saw in the news. So they're always working to try to find the best investments for the mutual fund, making you and the mutual fund more money. But as we all know, nobody really knows what's going to happen in the future, so a lot of times their guesses are wrong. Also, because of the management, you get charged a management fee, and that is the bad thing. Fees, even one that sounds low, like 1%, is hugely detrimental to your savings. That's 1% on your entire account every year. So if you had $100,000 in there, you would be paying $1,000 a year. On top of that, some mutual funds charge what they call a load. That's a usually huge fee that happens when you put money in or when you take money out of the mutual fund. There are front load fees. That means you're paying when you put the money in that are 5 to 6%, which is insane. And they charge that on every dollar you put in. And then back-end loads are fees for when you take the money out. So this is not only what you put in, it's also the gains. These loads are in addition to the management fees I talked about earlier. Most people who have these load funds have them because they've been sold to them by a financial advisor, someone who makes a lot of commission on those. If you want to read more about load funds, I'll leave a link below to thebalance.com. That's not my website, and I'm not affiliated with it, by the way, but it tells about what those loads are for mutual funds. So needless to say, your best bet is no load funds. When you buy a mutual fund, you'll basically go to Schwab or Fidelity or Vanguard and open a brokerage account. Then you'll put money into that account, and then you'll use that money to buy one of the funds. And there are a lot to choose from. One thing to think about is that mutual funds usually have a beginning minimum investment that you have to make. For Vanguard funds, it's usually $3,000 at the beginning, and then after that you can invest lower amounts like $50 a week if you want to. The hope for buying a mutual fund is that you're diversifying your money, because when you buy one mutual fund, you're actually buying a whole lot of different company stock or bonds or whatever it is. The other hope is that you'll get a good return, like 5 to 10% a year, and that is averaged over time. Some years your fund will do terribly, and some years your fund will do great. On the contrary, if you buy a single stock like Apple, you're not diversified. So if Apple makes a bunch of bad business decisions, or people decide they don't like Apple products anymore, or if it goes bankrupt, you'll lose the money that you put in. But if you hold a mutual fund that holds Apple stock, along with a ton of other stocks, if something bad happens to Apple, the chances are that the other stocks will be fine. So you won't feel the hit as much. ETFs. ETFs, or exchange traded funds, are a lot like mutual funds. They both hold a wide variety of stocks, bonds, or other assets, so they're diversified, but they're traded just like stocks. So this opens a lot of opportunities that might not be available with mutual funds. For example, the share price of an ETF might be $50. So when you buy that, you only have to buy one share. $50 instead of a $3,000 minimum investment like a lot of mutual funds have. There are a lot of other differences too, and I'll cover those later in the video. Index funds. An index fund is a type of mutual fund or ETF. Really, there are only a few differences between an index fund and a mutual fund. Index funds hold a portfolio just like a mutual fund, so they have a bunch of stocks or a bunch of bonds or other assets, but they match or track a specific category. The most popular index funds try to match the risk and return of the stock market. The theory is that in the long term, the stock market will outperform any single stock like Apple. So an example is a fund that holds the top 500 companies in the US. The S&P 500 is exactly that. The S&P 500 is made up of the top 500 companies in the US, and it's also used as an indicator of how the whole economy is doing. You've most likely heard of some of the companies on this list. Apple, Adobe, as in Adobe Photoshop, 3M, Tesla. So there's a lot of brand recognition there. So anyway, you might hear, well, the S&P 500 is up this year, and that's a good indication that the whole economy of the US is doing well this year. So there are index funds that match the S&P 500. There are other index funds that match the Dow Jones Industrial Average, which is actually only 30 companies. And the Dow Jones is another just indicator of how the whole economy is doing. Then you have more specific categories for index funds like healthcare or technology. You could buy a tech index fund and you would have a lot of different tech companies inside that. Now, the really great thing about index funds is that they are not managed very much. No one's trying to guess anything. No one's saying, oh, I think this will do better or this will do worse. They're only following those 30 companies and what they do. So a lot of it is automated, and that means your fees for these index funds are very, very low. So let's talk a little bit more about the differences between ETFs and mutual funds. Actually, most ETFs are index funds, so they track a sector of the market and they have very low fees. But let's take a look at some of the other differences. With mutual funds, a lot of times there's a substantial minimum beginning investment, like $3,000. With ETFs, you only need to buy one share at a time, so that can be $50 if a share of that ETF is $50, although the share price will change day by day. With mutual funds, it doesn't matter what time of day you place your order. You'll get the same price as everyone else does who bought and sold that day. That price isn't calculated until after the trading day is over. But with ETFs, you can decide what time of day to buy. Maybe you notice the price is a little lower or cheaper at 2 p.m. and you can buy it right then. With mutual funds, you can automate investing and withdrawals. So after you invest your first $3,000, you could say, well, I want to invest $50 every week, and you could do that automatically. But with an ETF, you can't make automatic investments or withdrawals like that. If you wanted to invest $50 every week, you would need to manually go in and purchase that ETF every Monday or whatever you decide. I really think of mutual funds and ETFs being very similar, and then index funds can be a mutual fund or an ETF that track a category. And those are the main differences between ETFs, mutual funds, and index funds. If you have any questions or comments, just leave those in the comment section below. And I've also started a Facebook group for this YouTube channel where I can try to answer your questions there. All right, I'll see you in a week for the next Finance on the Offense video. Thank you.